Are we going to just see, ever higher markets, or are we due a correction?
Good morning, Francine. I think it's really important to start with what's already priced into the markets, right? So in the beginning few months, you will see a mechanistic V for sure. You will see numbers both for surveys and also for hard data improving. The question is whether or not that can sustain real spending, consumer sentiment, whether or not that can sustain. So I do think that in the first couple of months, you'll see a V. I think it'll flatten out after that. The markets were already pricing in global growth being at the long-term average. The equity markets through the global growth for the long-term average, i.e., in simple English, the markets were pricing in this as a simple income statement blip. Which I think is wrong. Clearly, small and medium enterprises, and therefore the U.S. labor market, they employ 50% of labor across different countries, and I think that is a huge issue. The labor market is a huge issue, very different from previous recessions, and that will mean that consumer spending is going to be weak for some time. So pricing in this as a minor income statement blip, despite the massive stimulus, I think suggests that the markets have already overpriced the optimism, and I think they should be coming off here. Now, this means they come off to different degrees, depending on which sectors the market really has a higher weight of. But I certainly do believe that in pricing in global growth back to normal, the markets are looking through several years, not just through just the next couple of quarters, and there's a lot of uncertainty between now and then. So a lot of optimism is priced.
Are you more optimistic, Bhanu, about the U.S., or, given some of the composition of the markets, but also the economy overall, you'd be optimistic elsewhere in the world?
So, Francine, this is a really important point. There is a big distinction between the U.S. economy and the U.S. market. I'm not optimistic about the U.S. economy, and the reasons are obvious. The virus has been mismanaged. You get a large second wave, much better in North Asia, much better even in Europe. So clearly, the rest of the world is going to open up cyclically before the U.S. Economy is. However, the U.S. market, which has a very heavy preponderance of healthcare, tech, 52% is basically media, TMT, healthcare. I think that's the reason why the U.S. market is going to be a very difficult market to beat. And the currencies may be a slightly different issue. The euro may be quite difficult to sell here because you do see a little rotation away from the U.S., particularly the fixed income, the real yields in the U.S. coming down as much. The euro may be the one that's more bid than a major rotation into the rest of the world, or a major rotation into value, which is both of which the market has been trying for some time, I think unsuccessfully.
Bhanu, good morning. Tom Keene in New York. Carl Weinberg over at High Frequency Economics wrote a brilliant note this weekend on the dynamics of world exports. As you know, they're down, down, down after a really soggy previous year as well. How does a collapse in world exports fold into the silliness of gaming and guessing the so-called V-shaped recovery?
Tom, good morning. This is such an important point. I'll just briefly say, globalization has been slowing for 50 years. World trade was negative last year because, not just because of organic reasons earlier, you began to see tariffs impacting world export volumes impacting last year. Now you have coronavirus and you have the trade war, which is not being priced into the market correctly right now. You probably see trade volumes down 12 to 13% in year-over-year terms from a negative year last year. Now, if there's one thing that has driven global earnings for years, the ebb and flow of global earnings, it is the multiplier of global trade to global GDP, the elasticity of global trade to global GDP. And with that being this low, the market's consensus for earnings for H2 and 2021 is just simply wrong. Unless we see a synchronized pickup, which means a vaccine now, and a synchronized pickup everywhere else, even in that situation, I think the market's expectations of earnings are going to be wrong. I think the earnings momentum in terms of expectations for the second half of this year and also for 2021 is likely to come down. We understand that the valuation multiples will be high because rates are low and people basically start with the question, what else are you going to do with your money? Valuation multiples are going to be high, but valuation multiples need a realistic estimate of E. And E is driven by globalization, it's driven by trade flows, it's driven by capital flows. That's what the market is mispricing today.